All right, so we present to you our very special segment, which is Save Your Tax. And today we'll be focusing on every aspect of saving taxes, why the right kind of insurance. Now, be it life insurance, health insurance, or general insurance. We all know insurance is to be taken as a risk cover, as a protection for yourself and for your family. But then when it comes to savings tax, should this be your criteria of buying insurance? There are a lot of insurance policies that give you insurance as well as investment options. Should you be looking at those options just to save taxes or to have them align with your financial goals? Let's answer all of these questions. Today I have with me Harshvardhan Roongta, CFP, Roongta Securities. Harsh, welcome to the Money Show, and thank you for joining in. So 31st March deadline is almost around the corner, and a time where people buy a lot of or they look at a lot of tax saving instruments, and whichever they get first, which is usually an insurance policy in most of the cases, because this is the time when also we see a lot of mis-selling cases rising as far as insurance policies are concerned. Right way to look at insurance should be as a instrument that gives you risk protection. All right, but when it comes to savings tax, you have a lot of options in insurance. How can one go about it?
So, well, Kavita, you've rightly pointed out that we are at the fag end of the financial year. And at this point in time, I mean, all the individuals, or rather most of them, will be running around to save taxes because they have deadlines to finish with their investments to save tax. And the most convenient person available would be a life insurance or agent around you. And without application,
Okay. I think there is some technical issue with Harsh's connection, but then, as he was just rightly pointing out that it becomes very important for you to have the right kind of insurance. And this is a time when we'll see a lot of agents coming up at your doorstep. And, even if you go to a bank, you will see a lot of them selling you life insurance policies or maybe a ULIP plan. Plans where the main point of selling you a policy would be, getting the tax benefits since you are already late. Talking about having tax benefits, we know a lot of options, including a life insurance option and ULIP option, are there in ATC. But one has to understand that only if you are a taxpayer who's paying tax as per the old tax regime is allowed to have these tax benefits. The people who have transferred themselves into a new tax regime would not be getting any tax benefit on their insurance is concerned. The insurance portfolio is concerned. I think we have Harsh back on the line. Harsh, are you there? Okay. Yeah, you can continue your
yes,
explanation.
yes. Yeah, so Kavita, I was mentioning about this that at this point in time, when you're in a hurry to save tax, most likely you will buy into something which is conveniently available rather than what is appropriately required for you. So the first sense, that I would like to, point out to all your viewers would be that do not invest in any product. It's not about insurance or any other investment product. I'm just saying, do not invest in any product only to save tax. You have to look at the merit of that product. So what you do is ask yourself a question any time that you're going to be looking at investing. Would you invest in this product if there were no tax benefits available? So if the answer is no, then do not invest it. Do not invest in it only to save tax. That is exactly what I'm trying to tell you. So what you have to do is you have to look at your requirements, your goals, and your timelines, etc., and then find a product which matches with that goal and also provides a tax benefit. So that is okay and that is good. But if you're investing only to save tax and it helps you no other way in your financial life, then you should definitely not look at it. And at this point in time, as you rightly mentioned, towards the end of the financial year, you will have many cases of mis-selling. Something that people come and tell you and lure you for high returns probably and ask you to invest into something. Well, that's not how you should go about investing for your tax saving purposes.
Exactly. So, how should one actually look at insurance as a product and also as a product that helps you save tax? Okay. Insurance product giving you a facility to save tax should be like a byproduct of this investment that you might want to look into, or should that be the first priority to look at insurance, Harsh?
So, see, Kavita, first and foremost, insurance and investment should not be clubbed together. So, the purpose of insurance is to provide for a security in case of something happens. So, it's a pure risk cover. So, if you buy a life insurance policy, what is your primary objective, saying that as an earning member of the family is if that person is not available because of an unforeseen circumstances, he passes away or he or she passes away, then there is going to be a financial burden on the family because there was an earning member who's no more. So you want to replace yourself financially, and that is why you're buying an insurance policy. So that is your primary objective of buying an insurance policy. Now that can be fulfilled with a term insurance plan. You do not need to buy an investment oriented policy, because if you buy an investment oriented policy, you will not be able to buy the adequate cover because the premiums will be higher. So if you want a lower premium with the maximum cover, term plan is the only alternative. Now, term plan insurance premium also is eligible for deduction under Section 80C. So, if you buy a term insurance plan and you pay the premiums, you will get a deduction under Section 80C. Now, if you notice, government has been trying to promote this financial security and encourage individuals to buy such insurance policies for the welfare of the families and for themselves. And to motivate in this direction, government says that, okay, if the premiums that you pay, I allow you a deduction in your income tax. So look at it only from that angle. Now, the other insurances that an individual would require in their own setup would be a health insurance for sure. You need to make sure that in case of any hospitalization, you would need adequate resources to get a good treatment done, because the cost of medical treatment these days are skyrocketing. I mean, what used to be available at probably a treatment that was costing about 50,000 some a few years ago would be approximately 5 or 10 lakhs today. I mean, that's the basic level of how the cost of medical treatment is going up. So you need to buy adequate medical insurance. So by adequate, I mean if you're in metros, you would definitely need anywhere between 10 to 50 lakhs. If you are in non-metros, then probably a 10 lakh sum insured should be good enough. But given the combinations that are available today in the form of a base policy and a super top up, a family of four can insure themselves at a very reasonable cost for a sum insured of up to 50 lakh rupees as well. And the premiums that you pay, not only for yourself, your spouse, your dependent children, even if the premiums that you pay for your parents are eligible for deduction under Section 80D. So, as I said, club two things together. The tax saving would be a byproduct, not the main reason. So, I ask you a question. You need a medical insurance. Now, if you are in the new tax regime, so which is the default tax regime now, in which there is no deduction for Section 80D, would you not buy a medical for yourself? You would still go ahead and buy cover for your family. So that should be your attitude. Whether or not I get tax benefits, I am going to look at a product and take it because it aligns with my financial plan. If I get tax benefit, great. If I don't get, it's fine. It doesn't mean that I go and buy something else. So that is the basic approach with which you have to go and look for products that you need to in the last few days of the financial year, and do not get carried away and commit yourself for a policy for 10, 20 years only to save tax this year, but and then you pay on for the next 10, 20 years. I don't think that's a smart thing to do.
So question remains now. Obviously, you need to plan your life insurance and health insurance in place. And, Harsh, these are the first and the basic step when we talk about planning your financial portfolio. Now, given the kind of explanation you gave in order to have the right kind of insurance, how can one avail tax benefit as per 80C and 80D?
Okay, so there are few conditions that you'll have to fulfill. So first thing, as I said, so let's take it from what kind of insurances an individual with a family should consider. One is if all the earning members in the family should look at buying a term insurance family. So I repeat, it has to be earning members of the family, because there is a dependency on that income. Even if you're a single earning member family or a double income family, you need to ensure that the earning members of the family have adequate insurance. So term plan is one thing that you would look at. The other insurance is that earning members of the family need to look at is a critical illness policy. The premiums that you pay under that policy are eligible for deduction under Section 80D. The third that you need to look at is a personal accident policy, that is disability due to accident. If in case of any accident related disability, there's a monetary benefit that comes to the insured while he or she is alive. So that is the third insurance that you need to look at. If you're buying this at disability, a personal accident policy along with your term plan, then you get a deduction under 80C. If you're buying a standalone personal accident policy from a general insurance company, then there is no specific tax benefit available. Nevertheless, you need to still buy it in that case. The fourth insurance that you need to look at is a mediclaim that I spoke about. In this, you will insure all family members, whether earning or not, whether they're children, young children, infants, old parents, you would look to insure all of them. The premiums that you pay in those policies, which is the base policy and super top up, all of those premiums are eligible for deduction under Section 80D. Now, there is a limit to this. You can pay for yourself, your spouse, and dependent children, and the total limit under Section 80D is 25,000 rupees per annum. If you're adding your parents, if you're rather you're paying premiums for your parents, then and they are not senior citizens, so they are below the age of 60, then you have another 25,000 rupees that you can pay. So a total of 50,000 deduction can be taken. In case your parents are senior citizen and you're paying for them, then the limit increases to 50,000 rupees. So these are the limits that are available under Section 80D. And of course, if you're paying those premiums, you must take the benefit of tax deduction, but provided you're also filing your returns under the old tax regime. With regards to premiums under Section 80C, the term plan insurance that I'm talking about, or life insurance for that matter, there is a condition that the premium should be 10% of the sum insured. So basically, or the other way around, saying that whatever premiums you're paying, the sum insured should be 10 times of that. If you're not qualifying into that criteria, then you cannot claim deduction under Section 80C. So just be mindful of these sub conditions which are there to fulfill before you claim the tax benefit under respective sections, and then you're good to go. And these are the insurances that you should look at. All the policies that I spoke to you about are pure risk covered policies, pure protection. There is no investment element to these, and there is nothing comes back to you if nothing happens to you. So these are pure risk covers, which are ideal for for a family and to protect themselves financially.
Clearly. Let's also quickly, talk about having a ULIP plan and the factors that you might want to consider before putting money and once you also get your money, because there the rules have changed, in the budget a year ago, I guess. I know ULIP is a topic that we can talk, for a very long period of time. Harsh, we can give a lot of time to ULIP, but then here I have time constraints. So just in short, tax advantage on ULIP and the factors one might want to consider. And it is ATC. You might also want to just consider ALSS instead of ULIPs. Harsh.
Yes, absolutely. So coming back from the point where I said that insurance is meant only for protection purposes and there should not be clubbed with any investments, ULIP is a combination of protection and investments. So so from the tax element point of view, the premiums that you pay in a ULIP policy also qualify for deduction under Section 80C. However, there is a limit in terms of when you receive the maturity proceeds. So earlier it was the concept was that even if it's a ULIP policy and you pay as much as you wish, if you're paying more than say 2.5 lakh premiums, you're paying 5 lakh rupees as premiums, the maturity proceeds from an insurance policy are tax exempt under Section 1010D. So even if it's a ULIP and you're getting the money back, it's going to be tax free. That provision has changed and been modified to say that if your annual aggregated premium is more than 2.5 lakhs in a year, then the maturity proceeds are not going to be tax free. Earlier it was tax exempt, now it is not tax exempt. And that is, mind you, an aggregate. So it's not that only one per policy 2.5 lakhs. If you have three policies and all three have 1 lakh rupee premium each, so you're paying 3 lakh rupees per annum. So it is an aggregate, in an aggregated basis, you're paying more than 2.5 lakhs in a year. So the maturity proceeds that you get on all your ULIP policies will be taxable. It will not be tax free. So that is one part. Now, coming to the second part, yes, as I said, I would prefer to have investments separate in an exclusive pure investment product and insurance being separate. So ELSS works very well in terms of saving tax under Section 80C. So I think that is one element which people should very actively consider.
All right, Harsh, I would request you to stay connected because if you're talking about saving taxes, NPS is a very interesting investment instrument for retirement goal that one might want to consider. And so, the things about NPS is as the end of financial year approaches, it becomes essential to make well-informed decisions as far as tax saving is concerned before 31st March deadline. So Anand Rathi Wealth's Deputy CEO Feroz Aziz talks about saving money on NPS. Listen in.
There's also another provision of NPS,
okay,
which is a separate provision of 50,000 rupees a year. Not that I'm very excited as an investment venue for NPS.
Right.
Because it's too complex for a youngster to
Absolutely.
understand. Tier 1 account, Tier 2 account and all that. But irrespective, the 50,000 limit is a mutually exclusive limit and it's beyond the 1.5 lakhs is something worth informing the viewer.
All right, so this was about NPS, and earlier on the Money Show, we have discussed in depth as far as investing in NPS is concerned, and considering NPS as a tax saving option. You might just want to go on our YouTube channel and check out all the episodes of the Money Show, Save Your Taxes. But moving on, it's time to get our viewers connected, and let's start their life financial planning. Harsh, so we will take Sagar's question, and he says that he can park 50% in emergency fund into debt index mutual fund. That's what he's considering, like HDFC Nifty GSEC. June 2036 index, or SBI CRISIL IPX Gilt Index April 2029, or Dynamic Bond Fund. I think I have Sagar with me on the phone line connected as well. Sagar, hi, good evening. So we've taken up your question on the Money Show, and it's about creating your emergency fund. And you've given us 3 options. And is there anything else you want to add to your question? Because then I can just go ahead to our expert and have your query answered.
Sure. Just a minute. I have already invested. I have set the target for 6 lakh as an emergency fund. Okay. So among the 6 lakhs, I have already invested in 3 lakhs in FD with interest rate 7.98. So my next target is to collect this 3 lakhs. Okay. So I will collect within a few months, but before that I need to where I can it get invested, whether in the same FD with 7.98 or whatever I shown the index bond or dynamic bond. That is my query.
Sure. All right, Harsh, over to you.
Yeah, so Sagar, when you invest for emergency funds, when you're creating an emergency fund, there are 2 criteria which are to be considered. One is it should be easily liquidable. Okay, so your fixed deposits are liquidable and all other investments that you mentioned are liquidable. The second element that you have to be careful about is that I don't want volatility in this particular investment. Say, for example, you're investing into a target maturity fund with a 2036 as a maturity. Now, because there's a long duration bond, if there is any movement, it will directly show into it is going to be more volatile than what a liquid fund or low duration fund is going to be. So, in case the interest rates were to go up, you will start seeing negative returns on your emergency fund as well. So, when you're investing for emergency purposes, just keep in mind the objective is not to maximize returns. The objective is to keep volatility low. The objective is to get money as and when you want it without any loss. Now, while fixed deposit serves a good purpose, there is only a problem that if in case you need to premature withdraw, there's going to be a penalty levied upon by the bank for premature withdrawal. Now, compare that with a liquid fund or a low duration fund. Well, the returns are going to be not probably as good as a target maturity fund for which is maturing in 2036, but there is not going to be any volatility as well. So, what I would recommend that you stick to low duration funds, short duration funds at best. Otherwise, I wouldn't suggest a dynamic bond fund or target maturity funds.
All right. All the best with your portfolio, Sagar. And we move on. We have Karun Seth question. And Karun, thank you so much for sending us your question. I have all the details. I'm running short on time. If there's nothing more to add to your question, can I directly go to our expert and get your query answered? Karun?
Yes, ma'am. That's only the query I have.
All right. Perfect. Got it. Harsh?
So, he's investing 20,000 in total and allocation across different market segments. So, I don't think there's any problem there. However, in the large cap category, I would suggest that he pick an index fund, which is an ICICI approved BSE Sensex fund. All other schemes are fine. Just that I'm not too sure why he's taken the income distribution. I mean, why has he taken a dividend payout option? Because his time horizon long term. So I guess he should stick to the growth option, even for that Nippon India small cap fund.
All right, Karun, is there anything else you want to ask Harsh?
No. So, what was the first fund which you have stated? Is the ICICI which fund?
Yeah, so I'm saying in the large cap category, invest in the ICICI approved BSE Sensex fund and retain the other schemes that you have. Motilal Oswal, we don't know the scheme name. So you retain the HDFC mid cap, Nippon India small cap, SBI Contra, and just add the ICICI approved BSE Sensex plan in the large cap category.
All right, we move on to Harish's question, Harsh, and I think he has 10 funds in his portfolio and he's doing an SIP of 1,000 rupees each, and he wants to know the current fund selection is good enough for him or not, and he wants to invest at least for 10 years. And so he also wants you to suggest more funds, 2 to 3 funds for long-term horizon if that's needed, because he already has 10 funds, and which method is good, lump sum or SIP is what something he wants to understand.
Okay, so with regards to his own portfolio that he sent, about 10 funds that you have, I suggest that you need to prune it down to say only five. So I will keep all the schemes that you have, just increase the allocation from 1,000 per fund to 2,000 rupees per fund. So out of your entire portfolio, just retain these following schemes: HDFC Flexi Cap, Kotak Emerging Equity Fund, SBI Contra, Nippon India Small Cap, and ICICI Pru Balance Advantage Fund. In all of these schemes, instead of investing 1,000, invest 2,000 rupees per scheme. So you'll have only five schemes going further. Redeem out of all the other schemes and just invest it back into these five schemes itself. Now, with regards to your son's investments, because he's just starting off, I mean, investing in a lump sum or SIP depends upon what is your risk profile. But because you're asking this question and you're starting off new, I suggest that let him have a good experience by starting with an SIP or an STP. And the schemes that he could add in his portfolio to begin with would be one flexi cap and a one multi cap. So Parag Parekh flexi cap and ICICI Pru multi cap. Let him start his investments with these two schemes, invest via SIP or STP, and going further, he can add other market segments to his portfolio.
All right, I think that will be all for today. Thank you so much, Harsh, for being on the show and helping our viewers with their financial portfolio queries. And on that note, it's a wrap on the Money Show as well. But I'm going to leave you with our WhatsApp number and email ID where we want you to send across your questions so that we can do your live financial planning on the show. Thank you so much for watching. Goodbye.